Hello, everyone. Today on the final bar, we do our normal Friday routine, which is to wrap the week. Look at the market evolution from last Friday to this Friday, see what's evolved, see how the long-term trends have changed. The S&P selling off going into the close, finishing down around the 3550 level, it looks like, as we settle in here. So certainly further distribution failure at all-time high resistance at 3600. What does this mean going into the shortened holiday week next week? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lens of technical analysis and all the other peripheral inputs, focusing on the message of the charts, the message of price behavior, and being able to get inside the head of other investors by analyzing price movements. And when I think about the last couple of weeks on the S&P 500, I look at days like today, and it's sort of a one-day snapshot of what the last couple of days have been. A rise to to potential for further upside, but then being repelled and coming back down and finishing in a position of weakness. When I look at the sentiment readings, when I look at the price behavior over the last 2 weeks, I don't think it necessarily means high risk of further incredible downside from here. It's not an entrance of sellers that are pushing price down off of the highs. It's just an exhaustion of buyers. Feels like buyers are in, they've made their buys, the price has gone up. There's no one left, at least anecdotally at this point, to push the price much further. We're going to dig into that a little more as we look at price breadth and sentiment here on a Friday evening. Just to let you know the schedule coming up, we had some really good guests this week. I was super happy. My conversation yesterday with Mark Young was really cool about sentiment. Made me think about a lot of the relative movements and some of the sentiment readings that we look at. Next week on Tuesday, we have T.G. Watkins from Simpler Trading coming on the show for the first time. We're taking a bit of a holiday next week for Thanksgiving. Going to celebrate safely and at a distance with family outside of the area, but we'll be off next Wednesday, Thursday, Friday. Hope everyone's able to stay safe and celebrate with those that are special to you. And then the week after, on the 1st, we have Sean McLaughlin from Trade Ideas and All-Star Charts coming on the show. Let's get to our Wrap the Week segment. My favorite part of Friday here is we do the same routine every Friday, and I would encourage you, this has become part of my weekly routine to wrap the week every Friday. I hope that this, for you, at the very least, inspires you to think about your own weekly routine. What are the things that you should be looking at every week to sort of take a proper assessment of what's happened and think about your bets going forward? I did want to start with a quick poll. We had a poll going on our Stock Charts TV page, also on Twitter and on YouTube. Question was, which sector do you think performs better through year-end 2020? Two choices: consumer staples or consumer discretionary. And basically 2 for 1, the answer was consumer discretionary. And this comes from a common chart that we look at. I usually call it offense versus defense, looking at the ratio of the XLY, consumer discretionary, versus consumer staples, the XLP. And the idea is that you're looking at, are institutions rotating more to the offense or the defense within consumer? That's a clear bet that they could make within those types of names. And the ratio has certainly been favoring consumer discretionary up until now. So you get credit as honorary trend followers just for recognizing that part for sure. And especially on an equal weighted basis. We'll look at that chart if we have time for it. But we looked at it earlier this week where that ratio of XLY to XLP, if you look at the equal weighted version of that, it's even more so favoring consumer discretionary, showing you it's not just Amazon, which has faltered a bit. The average consumer discretionary stock is doing better than the average consumer staple stock. So fair response there, Team Final Bar. I would encourage all of you to look for ideas in either of those sectors, because I think you will find that there are good charts and there are weak charts in both of those two sectors. Let's continue our Wrap the Week. We're going to start just with a snapshot of where the week kind of panned out, and then we'll look at some other things. My labels might have jumped around a little bit because everything was chopping around there at the close a little bit, and the S&P ended up selling off pretty good. So these labels are mixed up, but you get the idea. The S&P is actually down here in black, down 0.8% or so. This is just right at the close that I took this. What underperformed the S&P? Not much, and it's just by a rounding error. The gold was basically down about the same amount. It was up a little bit today and sort of matched the distribution that you saw from stocks. Everything else outperformed stocks this week. The dollar was down just a little, about 0.4%. The NASDAQ finished almost flat for the week, down 0.2%. The rest of these really outperformed in a pretty big way. Emerging markets up 1.5%, bonds up 2.1%, small caps up 2.3%. You think about that ratio from small to large, and you see why that ratio is certainly favoring the IWM over the SPY. Look how small caps up over 2% with the S&P down almost 1% just for the course of the week. Crude oil up 4%. We've talked about energy and the strength in the energy sector. The XLE back above the 200-day moving average. Bitcoin, the big winner, and it's funny. I know many of us sort of mentally don't think of, or you tune out Bitcoin as one of the asset allocation options. But if you have not paid attention to it yet, I'd encourage you to. If you look at the last couple of years, there's a huge base. As Bitcoin has gone through 14,000, 16,000, 18,000 with further upside potential to certainly be there, up another 14% this week. Let's continue on looking at just what happened today, sort of putting today into proper context now with the weekly view. The S&P was down about 0.2% here to 3557 or so. Mid caps and small caps were actually flat. So it's interesting you see that large caps down and really accelerated to the downside. Small and mid caps actually chopped around and finished up around the zero level. The NASDAQ 100 down about as much as the overall market, and the VIX up a little bit to about around 2350. Bonds really moved a bit today with the TLT appreciating. This is coming off of a relatively weak chart, and so this is a pretty good follow through to the upside. 10-year yields back down to around 83 basis points. On the commodity side, gold and silver metals are up 0.3% each, oil up a little bit more, and overall sort of a net positive across the board with commodities. In terms of sectors, very quickly, and then we're going to get to the Mindful Investor Live chart list. We had utilities number one out of the 11 S&P sectors, materials number two. So those two are sort of flat for the day. Utilities is obviously a fairly boring sector. It is not the juice. It's not exciting, but these are stable companies in some cases with decent relative profiles, but especially with the dividend component, which is certainly impressive. On the downside, you have technology, financials, industrials, and we're going to look a little bit later about at technology. You know, I remember saying earlier this year, certainly on this program at least once, that technology, you think of it as sort of a core holding, the XLK. If you look at the long-term performance of the XLK, and let's jump there here real quick. Here's the last 2 years on the XLK. If you look at the last 2 years, look at the relative strength from the December 2018 low to where we're at about 3 months ago, the September peak. From point A to point B, consistent outperformer, strong relative performance, strong price performance, sure, but during downturns, the sector outperformed. During upswings, the sector outperformed. And something like this, that is good offense and good defense, meaning it's outperforming in a bull phase and in a bear phase, it's hard to justify not owning that all the time. And that's sort of a core holding. That's how I think of as you build a portfolio around charts like this that are going to perform well in any environment. That's changed a little bit in the last couple months, and you've seen that was the peak. When the market peaked in September, this is when that dominance of technology started to falter. This is when you see financials, energy, and really this is more industrials, materials. Financials, energy have come in a little bit later, but this is when things started to change, and the incredible uptrend in the FANG stocks has sort of taken a pause since then. No, that doesn't mean I think technology is going to go away, and I certainly see that there are plenty of really good charts in there. The reason why I'm bringing this up, just to switch gears a touch here, is to look at the semiconductor index. We'll look at the same chart on the SMH. It looks a lot like the XLK chart, except the relative strength hasn't turned down. It's continued higher. So I feel like sort of the safety trade, that stable trade that's going to work in any environment, maybe has become semiconductors within technology. It's not just tech, but it's semiconductors within technology. Sort of an interesting thing to think about. But again, it's charts that the relative strength line continues to go higher during bull phases and bear phases is a compelling chart I would strongly think about when you're looking for long-term opportunities. Let's continue on to the Mindful Investor Live chart list. This is what we usually look at on Friday. As a reminder, if you've not seen this before, you can go to my blog, which is click on articles. On the right side, click on the Mindful Investor. There's a link at the very top of that page for this chart list. You're welcome to review it, save it, do whatever you want with it. Chart number one is the long-term market trend. This is using weekly data, and it's driven on weekly exponential moving averages. Long-term, medium-term, short-term, long story short, these are all positive. The long-term model has been positive since early June. The medium-term model had turned negative about a month ago, but turned back positive a couple of weeks ago and back to thumbs up. The short term, which is literally just looking at where the price is relative to the 5-week exponential moving average, turned positive 3 weeks ago, and that is remaining. So, top to bottom, long term, medium term, short term, the trend is positive, and that's about right. That's what I would hope a trend following model would tell me when the market is at or near new highs. In general, what you would tend to see is the short term model would turn negative at the beginning of some sort of pullback. Once that is confirmed, the medium-term model would turn negative, and then the long-term model really isn't designed to be triggered until things really get bad. And that's that's only going to trigger, once every year or a couple of years. It's big long-term sell-offs that that's going to try to identify. So that's kind of how that could play out going forward if we do turn lower. The daily chart of the S&P is what we talked about earlier. We've talked about this range, 3,200 to 3,600. That's been a really good sort of a framework to think about the last couple months, and certainly has served us well here in October with the peak and the valley. When I think of the last 2 weeks and what it told us, this is when the elections were decided, I guess, quote unquote, decided. It's still lingering, and we still don't all have that closure that we're looking for, but certainly seems to be indicating a Biden presidency is fairly likely. So we have at least some direction there. We have a sense of what that's going to mean. We've had news on vaccines from Pfizer and Moderna, and the challenge, or I think the issue here, is the market hasn't gone much further. That news has propelled us back to resistance. It hasn't been enough to push us further. And so I think, for me, I'm now starting to see this period as more of an exaggerated top, similar to what you saw in February. The rally in February took us to 3,400. The rally into September sort of overshot it, undershot it, overshot it, undershot it. And you see we're rotating around that midpoint, which is around that same 3,400 level. I think that all changes if we get a confirmed break above 3,600. Shortened holiday weeks tend to be more positive than negative, but usually not a ton of volume and usually not dramatic things because there's not a lot necessarily going on. So we'll have to see if there's a catalyst to move us further to the upside. I think my conversation with Mark Young yesterday sort of hit on that. He had characterized the market being at a yellow light, and to turn positive or to turn negative, you need a catalyst. You need something that's going to, cause a change in valuation. We just haven't seen it in the last 2 weeks. Good news has pushed up against a ceiling that we've not been able to eclipse. In terms of breadth, I tell you what, the trend is positive. You can see that here from the cumulative advanced decline lines that I've colored all green. These are pretty much positive across the board. All 4 of these have eclipsed their August highs, have broken above their peak from October. All 4 of them at or near new 52-week highs. If there's anything to notice that is not impeccable 100% bullish, it's the fact that the NYSE and the small cap breadth lines have not broken above their January high yet. But man, that's a stretch. I'd much rather pay attention to the trends, and they're all making higher highs and higher lows. They're all in uptrends, and I think the breadth is positive. And again, that necessarily, it doesn't mean that is a glowing recommendation for much further upside. What it tells you is that stocks are actually participating in this move fairly broadly, and that overall is certainly a sign of market health. It shows you that it's not just the FANG stocks that are working; it's a little bit of everything. And I think that was the pause you saw in some of those AD lines now resolving to the upside. In terms of new highs, this is skewed a little bit because on the big gap higher 2 Mondays ago, you saw about 30% of the S&P making a new 52-week high on that Monday. That was after the Pfizer news. So since then, everything's going to look a little muted. But overall, this is still pretty healthy. This is a healthy number of new highs, about 10% last Monday. So overall, it's been okay. It's not shoot the lights out. Everything's going up like you've seen historically. In longer term bull phases, you'll get sort of 100, 150 stocks within the S&P consistently making new 52-week highs. We're not there yet. So the average stock has not broken to a new swing high just yet. An increase there would certainly be further and further bullish. One final breadth indication to look at before we talk about sentiment is looking at the percent of stocks above their 200-day. We're right around 89%. This isn't updated for today just yet. But overall, 80, 90, 85, 90% is pretty rare, and it's pretty similar to bull market tops. It's also similar to the beginning of multi-year uptrends. So if you look back and you look at 2003, if you look at like 2009, if I remember right, you had a big blowout sell-off where almost 0% of stocks are above their 200-day, and then all of a sudden it rotated back to around 85, 90%. So I can't say that that is the ultimate contrarian sell signal. It's more telling you the breadth overall has been very positive. We only have time for another chart or two, but I did want to point out sentiment. We talked a lot about in yesterday's show on Thursday, so I'd encourage you to check that out. But if you missed it, basically sentiment in the last 2 weeks has gone from kind of positive to euphorically positive. That's probably not the appropriate word, but that's what I'll use. Euphoria is, and John Templeton famously said, and I'm going to totally butcher this, but the end of his famous quote was, "Markets die in euphoria," and I forget the other parts of it. So sorry, John, but what he was basically saying is that markets start in skepticism at the end when everyone's euphoric, when all the buyers, the last buyer has made his trade, that's when things start to taper off a little bit. And what concerns me when you're looking at the name exposure index, which we've talked about, it's over 100% bullish or 100% positioned in equities, meaning the average active investment manager in this one is over allocated to equities, which if you look back is actually pretty rare. And it's similar to the end of a bull market cycle, not early in a bull market stage. The RIDEX flows are the most positive I've seen in a long time, and it's even eclipsed the early 2018 reading just before that sell-off. So you have extreme bullish positioning, you have extreme euphoric sentiment, the VIX put call ratios all making swing lows here. So I feel like the challenge with the S&P faltering at resistance and euphoric sentiment, the narrative that tells me is buyers have bought and they are in and they've made their trade, and who is left to push stocks materially higher from here? And certainly the last 2 weeks of faltering, stabilizing tells me more likely that we back and fill at the very least, if not correct, and get some sort of a pullback instead of just continuing on to new highs. That is our Wrap the Week segment where we hit on a lot of different things there. We're going to take a quick commercial break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate so much you joining us for the Final Bar every weekday after the close. We would love to hear from you, feedback on the show, feedback on our hosts, our guests, anything and everything, but especially questions that are coming up as you're analyzing your own charts. We are here to help you and help you navigate the markets and hopefully give you the tools and expertise you need to make better decisions in your portfolio. Get your questions to us a couple different ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video and hope to answer one of your questions in one of our future mailbag segments. Let's get right to the Final Bar Mailbag. Again, these are all questions we've received in the last couple of days. Appreciate so much all of you sending some thoughtful questions our way. First question. Hi, Dave. I followed a couple of hundred people on FinTwit, and frequently some will say that a stock is, quote, oversold or overbought, or short-term oversold or overbought. When I look at RSI on different timeframes, I don't see what they're talking about. Is there some other indicator that technicians look at besides RSI that would reflect overbought and oversold points? That's a really good question. And, RSI is by far the most common one. When I was at Bloomberg, and then my mentee, the person that followed me and now is a technical analyst at B of A, Paul Ciana, did a really good job at Bloomberg for a number of years, along with me, and then on his own. They did some great research actually testing on the Bloomberg platform what indicators people use. And the most common indicators after moving averages were RSI, which is basically the relative strength index measure of momentum. When I bring up a chart, there's a reason why the RSI is on there. I think it's a great simple way of standardizing the price movements and focusing on overbought, oversold conditions. That is not the only one. That is certainly one of them. If you go down to the indicators section, A couple that would jump out as I'm looking through this list, things that are very similar would be stochastics. And so especially when someone talks about short-term overbought and oversold, what stochastics does is it basically says, where is the price right now versus the highest high and the lowest low for the last N number of days. So, if you have a 10-day stochastics, it's looking at the last 2 weeks. Where are we at right now versus that range, high to low for the last 2 weeks. And so that's a common way people will look at overbought, oversold conditions. RSI, we've talked about Williams percent R would be another one. The Chaikin oscillator would be another one. Anything that has the name oscillator, the CCI, Commodity Channel Index. Let's see, Bollinger percent B is very similar to RSI. Those are also, so it could be some combination of those or one of those that people would be using. There's no standard thing for when we say overbought and oversold. It's really more of a shorthand. It's kind of like if you'd say cheap or rich. If a company or a bond is trading cheap or rich, it doesn't have an explicit meaning. It's more just a general sense. And I think that's what people are talking about. So I would guess if RSI doesn't match up, I would look at stochastics, which is the second most commonly used after RSI. Next question, great show and coverage. One question I had was, I saw mentioned in some Seeking Alpha article about how the smart money index showed smart investors and institutions were selling at 3:30 p.m. while the plebes like me are doing my buying in the first hour of the market section. Is there anything like a smart money index you can show us that would provide guidance to this kind of thing? It's a really good question. I know that indicator, I don't believe we have that on StockCharts. I should know that offhand. I don't believe so because I would have brought it up before. But I'm making a note because one of the things I asked Chip Anderson, our founder, if I could do was, look critically at our breadth coverage and see where there's some opportunities for indicators that we perhaps have not had that we could. And that's one that comes to mind for me. That's, on Bloomberg, I know I use it for a number of years, and essentially looks at that timing, the conventional wisdom, which pretty much plays out, is that first 30 to 60 minutes of the trading day tends to be more retail oriented investors. There's a lot of reaction to news, to earnings, to overnight, futures trading, all of that. The last 30 minutes is where institutions will tend to do their trades. And the reason is because of the impact. So if you're running a $10 billion fund, you're always concerned about how much if you try to go buy a stock and accumulate a meaningful position, you have to buy a lot of it. And if you just go and do that, it'll just cause a huge shock as all of a sudden the big orders come in and everyone sees what's happening and they try to get ahead of it and everything's kind of messed up. And so they do a lot of different things to try and cushion it. And one of those things is trade right at the end of the day when no one can do anything about it. It's sort of locked into the close and you're done. That's also when a lot of ETFs will do, rebalancing. So, if an ETF has to accumulate or distribute shares because of people in buying and selling the underlying ETF, they have to do that. And they'll always do that or often do that at the end of the day. So the end of the day is certainly more institutional and large scale adjustments. So there is an indicator where you look at that last 30 minutes versus the first 30 minutes of the first hour and kind of compare the two. I don't have anything to show you. I've made a note and certainly will follow up when I can give you more deets on that. The next one, if you look at the daily TLT, is that a bullish pennant setup? Can you explain why or why not? Sure. Let's look at the TLT. This is the long bond ETF. Okay, the daily TLT, is that a bullish pennant setup? So the problem I'm having is I'm not sure 100% what you're looking at because I'm not necessarily seeing a pennant. A pennant would be if you have a big run and then you have a short-term kind of consolidation of lower highs and higher lows. It's kind of a little mini symmetrical triangle. To be honest with you, I'm not really seeing that on the chart. If that was your question and you have a specific thing you want to send me, shoot me an email, thefinalbar@stockcharts.com, and send me a screenshot of what you're looking at. I'm happy to take a look and tell you if I see otherwise. But no, I mean, my read on this is not really any sort of pennant. And again, the point of a pennant, you have to remember that one of the key parts of a pennant pattern is a big rally first. So you have to have a big run higher, and then a pennant would be a shorter thing, or a big downtrend, and then sort of a consolidation after that. And I'm not necessarily seeing that here. I'm seeing a pretty consistent downtrend of lower highs and lower lows really since August. So I have to say no. But if I miss what you're looking at, send me a chart and highlight what you're looking at. I'm happy to take a look. What's your observation of DraftKings? Will it go back to the previous high? Well, I will have a disclaimer. One thing I do not know about any chart is what it will do. I can tell you what the chart is indicating to me and how I would think about it. So DraftKings is actually an interesting one. If you look at this, you had the nice peak in June, the pullback in July, the peak in early October, a higher low. So higher highs and higher lows are sort of the pattern. And now we're kind of midway through it. We're back above the 50-day. So I think, again, if you're sort of short-term, or if you're in a name like this, I think this is where you keep bumping up your trailing stop and sort of lock in these gains. And you have some good pullbacks here recently that you could use as swing lows that I would hope you stay on top of. Some people look at this and say, is this a head and shoulders topping pattern, which is a huge mistake to call it that. You can say it is starting to form something kind of like a head and shoulders topping pattern, but you can't call it a head and shoulders top because it has to break down through the neckline. So the most important line on my chart, if I'm looking at DraftKings, is this one, which is the low from July and the low from October. If we would break down through that at some point, that all of a sudden means you have a head, a shoulder, that's the neckline. And the general consensus is you take the height of that pattern, you'd subtract it from the lows, and that's taking you down around 20 as the minimum objective given that sort of thing. But that is not the case until you break down through that trend line, which tells me as long as you remain above that trend line, you keep making higher lows, the trend is positive. And so I would be looking at some short-term swings there, but also holding this line as one of the key ways to think about downside potential. The RSI is interesting because this last rally, it's still only around 60, which is more, which is not super bullish. You'd want to see it continue higher and see that RSI drift up a little bit as well. That is all the time we have for the mailbag. Those are some really good questions. Thank you guys so much for sending them in. If there's something we didn't get to, or if you have further questions, shoot us an email. We'll get to them on our next mailbag segment on Tuesday of next week. Let's wrap the show. Go to the 3 and 3. 3 charts, 3 minutes. Here we go. Chart number 1 is the name exposure index and the RIDEX bull bear index. We talked about this yesterday a bit when we dug into sentiment. We talked about it a little earlier in today's show. When I think about the S&P, when I think about the overall market, again, my goal is 3 things. Number 1, identify the trends. Number 2, follow the trends. Number 3, anticipate when the trends are exhausted. And I think the first 2 have undeniably been positive. The trend overall in the S&P is positive, more positive than negative. And I think you can follow that higher. I think the breadth conditions are solid. Overall, the trend is positive. So from a trend following perspective, it's up. The things that are negative in my checklist are all sentiment related. It's things like the VIX being at swing lows. It's things like the name exposure index being over 100%. It's things like the RIDEX flows being at extreme bullish levels. The call ratios recently relatively low. So these are things that are similar to bull market tops, not mid-stage bull markets. And so that's what concerns me from a big picture. Second chart would be semiconductors. I mentioned, months ago, I remember talking about the XLK and this dominance of technology driven by the FANG trade. And, sort of saw the scenario where technology outperformed in bull market phases and outperformed in bear market phases. That's the type of chart that I would love to be in because it works, on a relative basis, no matter what. If you're going to be in something as a core position, what better than that, which is going to, in general, outperform the S&P. That's changed, though. And if you look at the XLK since the September peak, compare that to the semiconductor index, the SMH has been a much better play, and it's had that consistent outperformance we used to expect from the XLK. So while the larger, those FANG stocks have struggled a little bit, semiconductors have remained positive. So that feels like the good offense, good defense that you might be looking for. And so I think that's certainly an area to be considering. Finally, is with bonds. Sort of the base case I've been thinking about is weaker dollar, weaker bonds, stronger stocks. And all of a sudden, you have this bit of a reversal where bonds have actually rallied pretty nicely off of a Fibonacci level here. It's coming off the 50% line. I don't know if that's as meaningful as the fact that it bounced off of the lows from June, right? So you had this choppy period in March. The TLT came back to find a low in June. You sort of retested this high area in August. You then had this nice stepwise downtrend, and now we're hitting that same range in July. We're right back up to the previous swing highs. We're just testing the 200-day moving average from below, testing the 50-day moving average from below, testing previous swing highs. If it's able to break above this, that bearish bonds thesis that I have in mind may be incorrect and we need to revisit it. A higher low would validate that, and a break below that 50% line would certainly suggest stronger potential for further lows. That's our show for today. Thank you all so much for joining us every weekday for the Final Bar. Please get your questions in. We'd love to hear from you via email or on Twitter. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. See you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.